Alright, the objective of this video is to briefly talk about the Rubber Futures contract which the MCX will be launching on 28 December 2020. So, without any further ado, let us jump in right away. Let us start with the fundamentals of rubber. Rubber is an important commodity that has played a critical role in the progress of our civilization. It is an internationally traded commodity that is actively traded on the Tokyo Commodity Exchange or the TOCOM, the Singapore Commodity Exchange or the SICOM, and the Shanghai Futures Exchange or the SHFE. Rubber is used across a range of industrial applications such as automobile, aeronautics, electrical and electronics, consumer products, healthcare sector, etc. But by far, the auto sector is the most dominant source of demand for rubber, occupying a share of over 50%. Within the auto sector, a vast majority of demand for rubber comes from tire manufacturers. Keep in mind that automobile tires are made not only from natural rubber but also from synthetic rubber, which is made out of petrochemicals. India is the second largest consumer of rubber in the world, the first being China. Combined, India and China together account for nearly half of the global consumption each year. India is also the sixth largest producer of rubber in the world. Meanwhile, Thailand, Indonesia and Malaysia are the top three rubber producers, accounting for around 70% of the global output each year. Asia is the major rubber production hub in the world, contributing to nearly 90% of the global output. Around 80% of India's rubber cultivation happens in the state of Kerala, with a bulk happening in the Kottayam district of Kerala. Do you know who this is? This is Charles Goodyear, the man who discovered a process called vulcanization in 1839. This process revolutionized the world back then and was one of the defining moments of the industrial age. But what exactly is vulcanization? Put it in simple words, vulcanization is a chemical process that enables conversion of natural rubber into more durable materials. In other words, vulcanization is used to convert rubber into its end products such as tires. One of the world's renowned tire manufacturing company, the Goodyear Tire and Rubber Company, was founded in 1898 and was named after Charles Goodyear. This table shows the production and trade statistics of rubber in India. As can be seen, the production of rubber in India fell sharply between 2013 and 2016, primarily due to lower price of natural rubber and rising cultivation costs, a combination that discouraged the cultivators of rubber. That said, we have seen a gradual rebound in cultivation since 2016 as the government took steps to make rubber cultivation attractive by increasing production and productivity and reducing the production costs. Meanwhile, India's rubber consumption has averaged over 1 million tons over the last 4 years. As consumption exceeds production, India must rely on imports to meet its demand requirements. Yet, India still manages to export natural rubber as and when the price becomes attractive. This is the historical daily price chart of the RSS4 rubber, which is the most widely quoted and tracked rubber grade in India. As can be seen, rubber prices have rebounded strongly over the past few months and recently surpassed 16,000 rupees per 100 kg for the first time in 3 years. One thing to keep in mind is that although the Indian rubber prices are domestically quoted based on local demand and supply conditions, they are still heavily influenced by trends of global prices as well. The steep rise in Indian rubber prices over the last few months has been more or less in sync with the rise in global prices. Let us now talk about the key factors that influence rubber. Production and consumption has a significant say in influencing rubber prices, as one would logically expect. In fact, One of the primary reasons why global and domestic rubber prices have risen significantly over the last few months has been due to two reasons. One is a significant surge in demand from China, which is the world's largest rubber consumer, accounting for nearly 40% of the global demand. And the other is due to rubber production being impacted due to weather and environmental conditions in Thailand, which is the world's largest rubber producer, accounting for over a third of the global rubber output. Health of the auto sector has a significant influence on the price trajectory of rubber. This is because over half of the demand for rubber comes from the auto sector, wherein it is used in making tires and other auto parts and accessories such as brake pad, window seals, windshields, airbags, etc. As natural rubber is cultivated, weather and environmental conditions can affect the level of rubber production and thereby influence the price trajectory of rubber. This is especially true in case of Thailand, Indonesia, and Malaysia, which account for nearly 70% of the global rubber production. IRCL stands for International Rubber Consortium Limited and comprises of 3 countries, namely Thailand, Indonesia, and Malaysia. This body was formed with the aim of ensuring fair and remunerative income for rubber cultivators of each of these 3 countries. As said earlier, combined, Thailand, Indonesia, and Malaysia account for nearly 70% of the global output each year. Hence, any major announcements or changes in trade policies by IRCL can strongly influence the price of natural rubber. As we know, over half of the demand for rubber comes from tire manufacturers. As said earlier, tires are made not only from natural rubber but also from synthetic rubber. Synthetic rubber is made from petrochemicals, which is a derivative of crude oil. As the price of crude oil goes up, the price of synthetic rubber also goes up gradually. And as synthetic rubber becomes relatively expensive to natural rubber, tire manufacturers can slightly reduce the proportion of synthetic rubber in favor of natural rubber. This increased demand for natural rubber can cause its price to rise as well. Meanwhile, the opposite is also true when crude oil prices decline. So, as we can see, changes in the price of crude oil tend to indirectly impact the price of natural rubber as well. Finally, as rubber is an internationally traded commodity, it is impacted by currency movements. A strengthening dollar vis-à-vis other currencies can cause the rubber price to decline and vice versa. This is a chart showing the correlation of TOCOM rubber futures price with that of the dollar index. Here, the dollar index price scale has been inverted to show the correlation better. Notice how well the two tend to move in sync. But because the dollar index chart has been inverted, keep in mind that the correlation between the two is not positive but is rather negative. That is, a rise in the dollar index is bearish for rubber and vice versa. This is a chart that shows the correlation between TOCOM rubber price and crude oil price. See that a rise in the price of crude oil typically causes the rubber price to go up as well and vice versa. Let us now talk about the contract specifications for the MCX Rubber Futures Contracts. The contracts would go live from Monday, that is 28 December 2020 onwards. One thing to keep in mind is that the rubber futures contracts would be available for trading between 9 AM to 5 PM and not until 11:30 PM or 11:55 PM, as is the case with internationally derived commodities. The trading unit would be 1 metric ton and the price quotation would be rupees per 100 kilograms. In other words, the price that you would see being quoted would be for 100 kgs. The lot size would be 10 and the tick size would be 1, meaning for every 1 rupee move in the price of rubber, you would realize a profit or loss of 10 rupees. As the current price of rubber is around rupees 16,000 per 100 kilograms and a lot size of 10, the total contract value would be approximately 1,60,000 rupees. The margin needed to trade one lot of rubber futures would be 10% or span, whichever is higher. The contract would be monthly contracts that would expire on the last day of the month. If the last day happens to be a holiday, it would expire on the preceding day. Importantly, delivery type for rubber futures contracts would be compulsory delivery. In other words, on contract expiration, all open positions would be marked for delivery. Hence, if you do not intend to take or give delivery, you should close out your open positions before expiry or roll it over to the next contract. Meanwhile, the staggered delivery period would start 5 trading days before expiry, including the expiry day itself. A buyer or a seller who intends to take or give delivery can submit an intimation to the exchange to do so during any of the staggered delivery period. Meanwhile, the final settlement price of each contract would be based on the average of the polled spot price over the last 3 trading sessions of the contract. Lastly, the delivery quality of the rubber would be the RSS4 grade and the delivery center would be Palakkad, Kerala. Finally, let us now briefly talk about the advantages of trading rubber futures contract on the MCX. One of the major advantages is low total contract value. As we said earlier, the total contract value of rubber futures is approximately 1,60,000 rupees at the prevailing price of around 16,000 rupees per 100 kilograms. And low total contract value subsequently translates to lower margin requirement per lot. Domestic rubber prices are heavily influenced by international rubber prices, and one can easily gain access to international rubber futures price traded on the TOCOM, SICOM and SHFE. Hence, if one has a view on international rubber price, he or she could use it to trade domestic rubber as well. As we know, rubber price is heavily influenced by the health of the domestic and global economy, especially the auto sector. Hence, if one has a view on the economy and on the auto sector, it can be used to take positions in rubber futures as well. Finally, anyone having an underlying exposure to rubber can use the futures contracts for the purpose of hedging their exposure and thereby mitigating price risks. We are pleased to announce that the MCX Rubber Futures contract would be available for trading on our FYERS platform once it is launched by the MCX. So stay tuned for further developments from our side. Well, that was all that we wanted to talk about in this brief video. If you liked our video, do not forget to click on the like button below. Also, hit the subscribe button to subscribe to our YouTube channel and the bell icon to receive regular updates from our side. Thank you for watching this video.